Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, the relevance and policy impact. I'm Govindraj, Ethiraj. Retail inflation has cooled off to a 2-year low in November following the government's move to scrap 500 and 1000 rupee notes. Consumer prices rose by 3.63% last month, the slowest since November 2014. Food inflation too has slowed to 2.11% compared to October's 3.32%. Now, lower inflation is good news, but not perhaps when the trigger is a contraction in demand of this nature. So the question we're asking is, what other impact could demonetization have on the economy in the near term? How will this trend mix with global factors like a strong dollar? And will inflation at home stay low for coming months? And what could or should be the fiscal and monetary response to this phenomenon? To discuss this, I'm joined by Sudip Bandopadhyay, Chairman of Inditrade Capital, Hitesh Jain, Senior Vice President and Analyst at IIFL, and Upasna, Bhardwaj, Senior Economist at Kotak Bank. Thank you all for joining me. Sudip, let me begin with you. So this was a surprise, right? And this in some ways tells you that there is a demand contraction in the economy, which in turn will have cascading effects down the line. What's your assessment?
Well, definitely it has a demand contraction impact, and obviously inflation will come down. It's not something which you should look forward to. The government will have to do something, and very clearly, whether the step is taken before the budget or at the budget, they have to take some steps to kickstart or give a push to the economy, push to consumption, push to demand. That's kind of overdue now, and I think that should happen. Also, remember the global scenario. RBI, central bank, is in a very peculiar scenario where the US interest rates are going up, and if they have to do the right thing for Indian economy, they should probably reduce the interest rates. But again, it's a catch-22 situation. If they're reducing the interest rates, there'll be significant pressure on the currency. So it's a very, very difficult equation which they need to solve. And I think it can be only solved if there is a push for the demand and the consumption, once again, through public spending.
Okay, so we'll talk about that in a little bit. Upasna, how are you interpreting the lower inflation numbers?
Well, if we look at the breakup, it is largely led by the perishable goods, the food inflation, for sure. And most of it can be attributed to the demonetization effect that we've been talking about. Yes, there have been issues because of which, the mandi people and the vegetable, especially vegetables basically. So all of that had to be shedded off because of lack of storage facilities, as a result of which we did see the food prices crash. But keeping that aside, we should not overemphasize the importance of demonetization on these low inflation numbers. Even if we look at the core inflation, not just the core inflation, because that of course has remained stable, we need to segregate that with excluding the diesel and the petrol prices. When we look at the core inflation, that has also inched lower. So basically the decline in prices has also been observed across services as well. So I think we should not overemphasize the importance of demonetization here in terms of getting a lower inflation number. Definitely, part of it is led by that because of perishable items showing a lower, sharp crash in prices. But apart from that, even the core inflation has come down.
Okay, I'm going to ask you in a bit about what this should, how we should be responding to this. What's your sense, Hitesh?
I think I endorse most of the views what he's speaking about. I think as far as government response is concerned, I think nothing can be done on the monetary side. We obviously handicapped by the narrowing differentials between the US bond yields and Indian bond yields. I think John Keynes is back. When I say John Keynes, I mean Keynesian economics. Canada started this year with announcing fiscal spending. Now Trump wants to replicate thing. India has to do a lot of things from the budget.
But India is already doing it. I mean, a lot of rural spending that we are seeing is public spending.
So I think post-budget, or as far as tax slabs are concerned, which they expected, a lot of kind of stimulus or aid is required to the rural side as far as the middle class participants.
So Upasna, if I just can sort of ask you to extend on that. So you said that don't overemphasize the impact of demonetization, and you're somewhere suggesting that we were on a lower inflation trajectory. So what does that mean in the near term then? If we were heading in that direction, could that mean, or should that mean that we should be responding faster than perhaps we would have anticipated earlier?
No, here, like I said, November was the bottom of the inflation trajectory, which we were seeing earlier as well, even before demonetization, and we expect that to continue. Having said that, from the policy perspective, of course, it is going to be a policy dilemma for RBI, for instance, because while yes, demonetization is expected to impact growth, and at the same time, yes, because of that, core demand is likely to have lower price pressures on inflation as well. But at the same time, global financial conditions are tightening. So these kind of balancing act RBI has to do, which clearly suggests that there's so much RBI can really do to avoid too much of a cascading effect coming from a rupee depreciation over a period of time.
Right. Upasna, let me ask you a slightly more layman's question. So the thing is, if you were to look at the past, if you were to place all these numbers alongside and take away the demonetization factor, what would it mean? I mean, would it mean, for instance, lower prices, contraction in demand, low inflation, reduced consumer spending, and how could it? I mean, or how would we emerge from such a situation? Is there an experience of having done so in the past?
Of course, the scale at which demonetization has happened, I don't think it has really, we don't have a precedence to that. Hence, it is very difficult to fathom exactly how things are going to pan out. But yes, if this problem was to persist even beyond, say, January or February, that's when we expect the impact of demonetization on growth to be much more durable, and that is where the problem would arise. I think, yes, another 1 or 2 months we'll have to wait and watch how things pan out. But if the impact on growth is going to be really durable, that's where I believe that the government will have to step up its government spending. The public spending has to be stepped up, even if it comes at a cost of slipping on its fiscal consolidation path, because there is so much RBI can do. There is a limitation on the monetary accommodation side, so that's where I think the fiscal space has to be created to offset the demand contraction that we are expecting because of demonetization, if that problem was to persist beyond 2-3 months.
So, Sudip, this is a question that I've been asking in recent previous Policy Watch episodes. To what extent does contraction in demand reflect a permanent move away from spending, or a permanently postponed spending, or is it just people waiting to get hold of money again so that they can go back and buy what they want?
Well, I don't think it's a permanent kind of
because in services
thing.
that happens, right? Because
It's something is lost.
Yeah.
But I think if the consumption predominantly where is getting curtailed in consumer durables, luxury items and things like that, which are just being pushed back. I don't think it's being given up forever. Maybe some cases, maybe 5-10%, it'll not come back, but the rest of it, I expect it to come back. So it's a postponement. But the whole question is, one doesn't know how long this will continue, how long this will be pushed back. Maybe if it stretches beyond a reasonable time, you may lose a higher percentage of that consumption which would have come otherwise.
Right. So Hitesh, you talked about using the Keynesian model. I mean, so if you look at, let's say, falling prices, and prices are falling, and more so maybe in rural India, but maybe in urban India with a lot of products and services, that should also at some point spur demand. Of course, we may not have the money to actually go out and buy what you want. But where does this equation meet, if it does?
So I reiterate, people don't spend because people spend when they're sure about their income growth prospects. The moot point is how the transition of participants in the informal economy to the formal economy.
Right. And to that extent, maybe there is a divide in India because it's the informal which is more unsure than the formal.
There's a resistance also. So people try to find loopholes. There's a resistance to people moving from informal to formal economy.
Okay. Sorry, Sudip?
I think it's a very, very sensible what he's saying is that, you have to understand, India was an economy where quite a lot of the economy was functioning on, not the check. It was functioning in cash. I'm not saying everything was illegal, but it was functioning in cash.
Sure, of course.
And to move that overnight, it's a huge, huge challenge. The mindset has to change. So it'll take some time. Also, the issue of supply of currency, it also has to be normalized before people feel confident. If today you have money in the bank but you can't withdraw it, I think it's a huge dampener for spending.
But is that the same as income uncertainty, or you think it's linked?
I think it's linked.
Okay.
One is there is income uncertainty. Second is you can't withdraw money. So you're a little unsure whether you should be spending at this stage or not.
Okay.
These are all temporary things. I'm sure this will go away.
Right.
The sooner this goes away, the better it is.
Right. Okay. So Upasna, let me bring you in. So do you concur with what Hitesh says about income uncertainty? I mean, is that likely to be a dominant factor in coming months?
Yes, at least in the coming 1 or 2 months, definitely income uncertainty will play a very big role, which is likely to impact overall growth. But I think just to add to the currency in circulation, for instance, before demonetization, currency in circulation was around 13% of GDP. Now, that was already much higher than international standards. Where we are currently, obviously that cash crunch has caused us to shift to a 7 to 8% range currently. Till this cash crunch persists, we will probably remain at 7 to 8%, but we will gradually normalize towards, say, something like a 10.5% of GDP as currency in circulation. So when that really happens, we will gradually start seeing an improvement in growth, in demand overall, from 7% to 10%. But it may still not be as much as it used to be probably when we were at 13% of GDP. But at the same time, the increased focus on digitization would probably start playing or bringing in the benefits that come along with improved technology, and hence we would over a medium term probably start seeing the positive impact on growth because of that as well.
Okay, so cash coming back into the system, though not in the hands of people because they're still standing in lines. Digitization, so those are the plus points of how the economy may go in the next couple of months. Hitesh, are you in concurrence with that?
Yeah, that will happen, but that will happen over a period of time. It's too early to talk about this.
Yeah, but and people are not sure. I think that's a fundamental question. Last word, Sudip.
I completely agree with this thought that I think we need to be sure when it's going to happen. The sooner it happens, the better it is. And also, I will reiterate the fact that to kickstart consumption, to bring back the consumption demand, there needs to be public spending. Private spending is constrained today. Public spending has to come.
Okay.
To
but
ensure.
But we were also already on a high clip on public spending, and
well,
you feel
I think
we should.
We need to do more. We need to do more because of the unusual circumstances.
And the
as
money,
Upasna
and the
was
money is there
mentioning.
for that?
I think the money should be made available for that, even if it results in a higher fiscal deficit, because you are in an extraordinary situation. It's completely unprecedented and extraordinary situation. Everybody knows there is a contraction of demand which has happened. You have to do something which is out of the box at this stage to ensure that the economy keeps chugging.
Right. Okay. Thank you both. We run out of time on this segment. We are going in for a break. Coming up on the other side, we talk about the Fed rate hike and what it means for the Indian market. Stay with us. Welcome back to Policy Watch. The US Central Bank or Federal Reserve has finally hiked interest rates by 0.25% to between 0.5 and 0.75%. Moreover, the Fed has provided a roadmap for 3 further interest rate hikes in 2017 and 18. Now, the impact of the hike was felt on commodity prices, with gold falling to its lowest in 10 months, while the dollar surged to its highest in 14 years. Oil prices too were subdued. Indian stock markets have been holding largely steady as the hike was factored into prices for some time, but this could change for the negative. Now, the question we're asking is, what could be the long-term implications of the rate hike? Will emerging markets like India see more outflows on top of what we've already seen? What could be the new order for capital flows for stocks and commodities in coming months? To discuss this, I'm joined by Sudip Bandopadhyay, Chairman of Inditrade Capital, and Hitesh Jain, Senior Vice President and Analyst at IIFL. Thank you both for joining me. Let me begin with you, and let's start with a very simple question. Why are we in India concerned with the Fed rate hike?
I think, FIIs have been bringing in significant money in our markets. And remember, most of the FIIs, a lot of them, the US is the home market. So if the cost of funds are moving up in the home market, obviously their investment decisions do get impacted. We are not saying that they will not invest in India, but of course the economics becomes different. So obviously as a market, India as a market which receives a lot of money from US, we have to be concerned. We have to be cognizant of the fact that costs are going up. So yes, there's a cause for concern, but I think considering the growth potential of India and the way things are moving in India, it's not going to be a long-term concern.
Okay, and I'll come to that in a little bit, and we'll also talk about commodities in a second. But what has happened in the past? I mean, the Fed has hiked rates in the past too, in preceding years.
That's right.
What has been the impact on our markets?
Well, I think immediately there has been a knee-jerk reaction. I mean, I can talk about the last hike, but markets have absorbed that and moved on from there. And we saw pretty much the same thing happen this time as well. There was hardly any impact because market was factoring in 25 basis point. The commentary was little hawkish, but I think that also, considering the way US economy has been performing over the last few months and few quarters, it was kind of expected. And with the new president, very incumbent, very, very positive on increasing the rates and moving the economy in US from a monetary stimulus to a fiscal stimulus. I think the writing was on the wall.
Right. Okay, so let's understand commodity prices have been hit quite hard by the hike in Fed rate. So what is the reason and where are you seeing the maximum impact? Of course, gold being the most evident or obvious.
See, obviously 25 BPS hike was a foregone conclusion, but the moot point still remains whether Fed will persist with the so-called process of policy normalization as per the projections. Because if you look at the dot plot, where they're talking about 3 rate hikes this year, I think there's still an element of skepticism, because if you as a case in point, during December 2015, Fed actually went for a rate hike, and their dot plot, or saw their so-called future interest rate trajectory, indicated a rate at least 3 or 4 rate hikes. But what has happened is things have not gone according to the script. If you look at the GDP projection or the inflation projections, now the GDP is growing around 2%, the real GDP growth. For 2017, 2018, their GDP hovers around 2%. So you're not going to see a big growth or pickup. They are not forecasting, at least. As far as inflation, they look at the key gauge called as PCE, core PCE. Now they are around 1.7%. They're projecting 1.9 for 2017. And 2% target is attained in 2018. So I'm not sure whether the kind of pace they're talking about, they're going to persist with it.
Right. Okay. So that's the backdrop. Okay.
That's a backdrop. Obviously, gold has been hit, but I think it's a trap. I feel that there's a lot of element of uncertainty in the forthcoming months, especially from Europe. There's a big question on the existence of Europe, emanating from France elections in around May, in Germany elections in about August or September. Obviously, there's been rise to Eurosceptic and immigrant.
So, Hitesh, let me put the question a little differently there. So, to what extent is there a correlation for a lay viewer between rising Fed interest rates and the prices of key commodities that we all experience?
And hawkish Fed policy generally translates into a stronger dollar, and with most of the commodities being dollar induced, you're going to see lower commodity prices. In the short term, obviously you're going to see a stronger dollar, where the dollar index or dollar against the basket of currencies is projected to move higher, probably towards 104, 105. But I don't see it sustainable. There's going to be a big question, because markets to an extent have jumped the gun as far as too much rhetoric on fiscal spending, corporate tax cuts. The numbers don't sum up, you understand. Now, Trump is talking about 1 trillion spending on infrastructure the next 10 years, corporate tax being cut from 37% to 15%, and he's talking about GDP growth of 4%. So you understand, generally if you understand the Republicans' inclination, Republicans are never enamored by higher fiscal spending when the government debt is too high. As a case in point, again in 2009. When
so you're saying, no, so what's the conclusion of this? That these things may not pan out and therefore prices will come back?
They will not materialize as per markets have actually factored in.
Okay, so you're saying markets are overreacting to some extent,
yes,
at least ahead.
Yes.
Okay, Sudip, a couple of questions. So if you were to look back at the Indian economy, and you said that there is resilience in this. Now, can you define that resilience, particularly in terms of companies, numbers, projected earnings?
I'll tell you, Govind, straight away one thing. In spite of this demonetization slowing down the economy, and even the worst critic of demonetization is coming back and saying growth will slow down, things will not work the way it was working, and probably you will end up with 6.5, 6.9% growth, GDP growth, even this current year. So if you factor that in, even that kind of growth is not being seen in any of the larger economies in the world. So, very clearly the investors who have investable surplus will be in India. Indian companies, a whole lot of them are not getting impacted by demonetization in any manner also. So I think there is enough and more kind of strength in the Indian economy to withstand these headwinds and continue to move ahead. And as Hitesh was mentioning, I think the case for these 3 further hikes which are being projected may or may not happen. So I think the FIIs, the investors also will buy that view and continue working as long as there is an arbitrage, as long as there is a benefit of using dollars to buy assets in India.
Right. So again, a slightly larger question. To what extent should we be looking at global liquidity and what is happening in the US economy in the next 6 months to a year? I know we look at it to a large extent, but suppose I were to ask you, if you were to put a percentage on it, what is the amount of
Well, I think, if you're talking about the capital markets, it will be a significant percentage. Liquidity plays a huge role in the short term. Govind, long term is determined by fundamentals. Short term is always driven by liquidity. Right. So if you're looking at a few months time horizon, liquidity always plays a big role. So yes, international events, including predominantly US events, will have a huge bearing on Indian capital markets. Of course, we will also have to wait and watch what policy measures Government of India takes, whether it's in the budget or before that, to kind of neutralize or reduce the impact of demonetization.
Right. Okay, so Hitesh, this is a question we asked in last week's Policy Watch as well. So to what extent do you see the influence of global factors, including obviously the Fed, and the counterbalancing Indian forces, which could maybe relatively weaker or may get stronger after a few months?
See, obviously, the long-term macroeconomic profile is definitely healthy, but as far as the impact of so-called demonetization, I think the jury is still out, because this kind of an overhaul is unprecedented. And you cannot miss one point that is indisputable, as I mentioned before I was speaking to him, that the so-called formal economy definitely hinges on the unorganized or the informal economy, where a common man spending and then eventually adding up to the revenues or the bottom lines of the so-called corporates. So I think one thing for sure, the certainty there is short-term pain, slowdown is certain, but the duration of slowdown we don't know, because we need to understand participants or the value chain participants in the informal economy. For them, making a transition towards formal economy is going to be a painful one. And there's going to be a question, obviously there's going to be wealth destruction, because a lot of people may not able to convert their so-called wealth into the white kind of thing. But there will be a question on the future income growth prospects, because people don't spend because things get cheap. People spend when they're sure about the income certainty.
Okay, so you're saying that the domestic factors are going to be strong, but will they overwhelm, or will global factors continue to rule?
I think global factors continue to rule. Look, demonetization.
And this is really a question post the Fed rate hike.
Yeah, I mean, look at Govind this way. The demonetization happened, announced on 8th. From 9th, there was a significant correction. But market came back because liquidity was there. Yeah, FII started selling. They did sell, but DII started picking up. So as long as you have liquidity in the system, markets will continue to move ahead.
Right. So
fundamental strength is there in the economy.
Yeah. So then let me ask you the question on domestic liquidity, right?
Sure.
So domestic liquidity was driven obviously by domestic investors. Yes. Now, is demonetization going to impact that in some ways? Do you see any effect of that?
I don't see.
I mean, obviously, people don't put black money into mutual funds,
absolutely.
But nevertheless,
the point I'm making, Govind, is that I don't see that happening too much. And if the government comes up with the right policies, whether it's in the budget or before that, to kind of give boost to the economy, I think money will flow in once again. As you rightly said, it's the legal money which moves into the mutual funds and stocks and other things. So I think the flow will not stop. That will increase only if there is good policy measures.
Right. So let me come back to the commodity question, which we started with, Hitesh. So your prognosis on what's going to happen to key commodity prices, including gold and oil, in coming months?
See, I have a different version, because if you see of late, markets have actually just priced in the juicy part of Trump equation, where so the narrative has completely changed, where people used to see Trump as disruptive once he's actually won the elections and obviously going to assume power in January 20th. They look at the juicy part where he's going to spend, corporate. But what about his protectionist stance? As far as uncertainties in Europe is concerned, it's a big elephant in the room. Nobody's talking about it. So I think that's going to lead to a big disruption, and that kind of augments these appeal for commodities like gold. So I still think gold is still not on the reckoning.
Okay. So you're saying gold will therefore bounce back?
I'm so a longer term perspective, as far as asset allocation call, I think gold is still in the reckoning. As far as industrial commodities are concerned, I think there's nothing to do with the US. They are basically rallying higher on a lot of Chinese stimulus, Chinese credit injection, Chinese real estate sector. But I think that will be transient. There's going to be overheating, and Chinese will definitely clamp down, because they don't want to have another series of overheating in the economy.
Right. Okay. So last point, Sudip. So are we ending the year on a reasonably stable, flat note as it appears today?
Well, I think we are ending the year on a reasonable note, I would say. We could have done better, but for this demonetization and things like that. And
overall, if you look at our market performance vis-a-vis other emerging markets,
I think we have done pretty well. We have done pretty well.
So Russia, Brazil and all have done fairly well.
Of course, we have done better than those economies, and I think we will continue to do better. I have no doubt, and we are ending the year on a good note.
Tell me, we've run out of time completely. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.